Okay guys, we're going to look at the crux of a basic strategy. I was asked about the London strategy, the London breakout strategy. What's the best way to trade it and is it profitable? Well, let's roll the intro and we'll find out.
Matron, take them away.
So warm welcome to one and all. If this is your first time here, you might find this channel a little bit odd because everything we do is kind of live and in the moment. We don't do any scripts, so it's off the top of our head. And also sitting next to me off the top of her head is the Wild Wonder, who's meant to be working, but she's not. She's spending.
Dinner break.
Hold on, let's have a look. That's all right, that's your card. Because she has a habit of bankrupting me, but today she's spending her own money. Whoa! So it must be a good day. Possibly.
I don't know where your wallet is.
It's right here in front of me. You can keep your bloody hands right. There it is there. I'll keep that in eye shot. And if she doesn't sort herself out, she'll get a clock. Oh no. It's not the only thing that goes a bit limp in the night as well.
Oh, that's disgusting.
Right. Strategy. London breakout. As I said, this thing, we don't script jack all here. And when you see me trading, it's in the moment as well. I don't believe in rollback charts. I just get on with it. But the London breakout is through two ways. It's best on pound USD and euro USD. And there's also two main time frames to check it. Check it at 7 o'clock in the morning, so it'll be the breakout between the 7 and 8 o'clock for the euro USD. And if you're trading pound USD, it's 8 o'clock to 9 o'clock is your opening range. And the idea is, as it breaks the range, you're then looking to ride it out. Now, the traditional version of this is it breaks, stop at the base, and then you're running it to 50 pips, win or lose, and that's it. All right. Does it work? Yes and no. When the market is in a trend form, it's wonderful. But then you're capping your 50 pips. You want to try and run it as long as possible. Or you can do it in a sensible way and do kind of a box strategy where you box it in and you're moving from box to box to box. And that's kind of what we're going to look at today. Now, we're going to assume that we're looking at pound USD, so it'll be the 8 o'clock candle we're looking at. So the first thing you need to do, this is the current chart, and we'll run it back a few days, is to establish the first 8 o'clock. So that's this candle here. This candle here is the 8 o'clock. So we'll establish your range. So put a line across there and a line across there. That is the opening range of the market. Now, as you can see, it is broken off to the upside. So the traditional way of doing this would be you would place your stop under the candle here. So that's the stop. The entry point is here. And you look for 50 pips or 1-to-1 minimum. So your minimum target would be here. Would be there. Okay. And your max target would be 50 pips, which would be here. Okay. So that's the old way of doing things. All right. And the way that would work is you either pull the plug here or you pull the plug there, and that's the end of it. All right. And the main way of trading it was you always traded it to the 50 and you use that as a break-even pull point. Okay. that's about as simple a setup as possible. But if we go back in time slightly, and we'll go back to, say, yesterday, which is this candle here, this one, and we apply the same criteria. So there's your opening rate. I'll tell you what, we'll change these to black, just so they stand out a little bit. There we go. To there, okay. It broke to the bottom and then started running around, but it was actually an upward trend. But it did stay below for quite a while. So again, if we're looking for 50 odd pips, so there's your breaking point, and you're running that all the way to 50. It didn't get there. Didn't even get close to it. So what would have been 1-to-1? Would it have made it 1-to-1 trade? You've got it to risk-free. All right. So is there a way we can do this that is quite simplified? Well, there is. All right. And this is where you use boxes. Okay. So there's your identifying range. Draw a box on it for the day. So draw a box just like this. And you have red boxes and you have green boxes. So it broke to the upper side. So these are going to be green. So you have a nice green box, which is there. That represents 1-to-1 from the point of entry, duplicate it. And you put another one there. Now the idea is you're going from one box into the next box. Now once it gets to the box, you then move your stop loss. But you also need to know where that stop loss is. Now if you put this on the other side of here, just like so, and this is red. Kind of a different way of doing things. This is kind of no man's land. Now from here down to there, if you are familiar with pound averaging, dollar averaging, or the Scruffy squad where I trade, which is madness, I would be madnessing from this point to this point and then I'd be out. Okay, so my point of no return would be here. Put this in a big thick red line. So there's my stop working out this. Now it's based on the range. That is there. So my entry point is there. So it's effectively 2 boxes down, but I'm also targeting 2 boxes up. Okay. Now there is a little bit of a twist in this, because if you are pound averaging, you can buy into this coming down to the tip of here, and it would reduce your exposure. As it reduces your exposure and it moves to the upper side, it increases the upside. If it just runs for you, brilliant. But that's where the boxes take over. And what we're going to do with this, in this case, is it runs up, it's come away. You'll be averaging in when it gets halfway through, averaging in a little bit here, averaging in a little bit here, and then out. The caveat is your position size is broken up at the point of entry. You do not go 100% and then add into it. What you do is, if you were to say £5 a point at this place, you'd go a pound, a pound, a pound, a pound, a pound, and so forth, till you've put your whole position in. Let it run. Fantastic. Now from here, what happens is, you're looking for the price to get into this box. When it does, you move your stop to the edge of this box. So your stop, if it runs, would move to here. You can't lose anything anymore. But the price is inside this box, and you move that up onto itself. The price carries on, gets into this box. You move the stop to the base of there, and then you do the cycle again. till it breaks through and it runs and it runs. That's the basic premise of the breakout strategy, but using box work to help you. Now, we'll take this back a little bit. And we'll just find the next sort of 8 o'clock. Where's an 8 o'clock? Well, there's an 8 o'clock here. Okay. And we'll do a couple of examples. So where's it at? There it is there. I'll just get rid of the drawings. So we'll establish a range. So get our box. There's 8 o'clock. Pull down just like so. So that would be the stop range up there. Duplicate under here. I'll just turn this to be green and then double it. Okay. What we can see, it's come into here, it broke through this box. So your stop loss now gets moved to the point of entry, which is here. The price is now inside this box, so we move that down to there. As the price has come down, you can monitor this on a 15-minute chart, etc., or 5 minutes, but it comes down, has broken through, so you can now move your stop, lock profit in, just like so. It's come down, it's actually broke out again into the next box, which is down here. So you can move that to there, which gives you your stop, and then you move the next box down. It never got into this box. So from your point of entry, which is here, just systematically following it down and moving the stop would have netted you 60 pips. Dead simple. All right, and that's a basic way of doing it. There are other ways to manage your trade. You can put oscillators on to help you hold on to the trade. When you think it's coming to a low point where the price may possibly turn around, i.e. key levels, etc., you can pull your stops into the tops of the candle, on the hourly candle, that is. So you pull your stop to there, runs down, this one closes off, and as long as it's going red, you move the stop with it. Closed off. This one then closes off, you wait for this candle to close, you move it down, brilliant, you move it down, brilliant. You don't move it at all because this is green going into it, and then eventually it might clip you out. If it didn't stop you there, it would come down and you would follow it all the way, and that candle there would have definitely have took you out. So it would have been that one. And that's a way to ride it down. Simple. So we'll do another example. Could be a bitty example. Where are we at? So it's this candle here. So let's have a look. That one. All right. So again, opening range. Draw a box on it, like so. You can see it went off to the downside. So put these in first, duplicate, duplicate, and then your stop box goes on the other side of it. The right one, yeah, which is there, just like so. So it enters, comes into this box here. Brilliant. I can now pull my stop to break even, and what you're looking for, you're looking to target the second box. Comes down, doesn't quite, it tags it, so you can pull this down, because if you're monitoring this on a 5-minute chart, there'll be a 5-minute close there. Pull your stop to that box and then move this one to the other side, come round, and then it tagged you out, and that trade would have been that's 17 pips. Okay, but it was risk free. So again, it's all about the management of how you're doing it. And if you were looking to hold the trade, say you didn't get out of it in one thing and another, and you held your stop up here, bang, 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 didn't go to the stop, and then it collapsed. Now, what I'm going to say about trading is there is no magic pill, guys. I did this as a quick snapshot in response to somebody asking me what it was. And I don't particularly like mechanical systems, but they're a good way to start trading. You don't need any indicators with this. All you need is an opening range and common sense. Okay? You allow it to breathe by going 2 box one way, which is why you only have one red box, because it's the opening range plus the stop, and then you're looking to target 2 boxes from point of entry. So theoretically, you're always at 1-to-1, and as long as you win more than you lose, you're fine. But the way to put it in your favor is you pull it to risk-free and then ride it as long as possible. So some of your trades, you might get into 3, 4, 5 boxes, whereas some of them might only just be a few pips. But those runners will help pay all of that off. So I hope that helps. If you're stuck, just ask. I'm always about. There's hundreds of ways to trade. Personally, I prefer what I call golden eye, because I would have a golden eye inside of this. And golden eye is a full way of road mapping a chart. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.